Many people with federal student loans choose to pay them back using plans called income-driven plans, where your payment is based on a percentage of what you make rather than actually what's needed to pay your loan off in full. Now the question is, does this impact your credit? My name is Brenton Harrison with Ultra Borrowers Academy, an online course where we help people with a mountain of student debt take back control of their student loans, and we are here today to answer the question of if income-driven plans negatively impact your credit score. Let's get started. Income-driven plans are plans where the payment that you make each month has no connection to your loan balance. Instead, they base those payments off the 10 to 20% of what's called your discretionary income. And that income calculation and the payment calculation may not be enough to actually pay down your student loans, so many people worry if that means that they're going to be seen as delinquent or making late payments on their loans or not paying full payments on their loans. And when they look at the case of their credit, fortunately that's not the case. So let's cover a FICO credit score, what goes into that credit score, and how it's impacted by what you're paying on your student loans. For your FICO score, the largest percentage of what makes up the score is actually your payment history. So, put frankly, do you or do you not pay your bills on time? So we're going to come back to delinquency and default in the future, but at its core, 35% of your payment history means that as long as you pay your student loans on time and you pay all of your other bills on time, then the biggest part of your FICO score, which is your payment history, will actually be positively impacted by your student loans. Now, I know you don't want to take out student loans to help your credit, but the fact of the matter is the longer that you have those loans and the stronger your payment history, the better it will reflect on your score. Now, the next part of your score, which is 30% of your FICO score, is your utilization rate. Now, utilization rate is an expression of how much of your revolving credit you have borrowed at any given point in time. Now, revolving credit is an example of something like a credit card or maybe a personal loan. So what a credit bureau will do is they'll look at how much debt you have available to you. So for example, let's say you have a credit card with a limit of $10,000, and they'll look at how much you've borrowed, and whatever that percentage is what's called your utilization rate. So for example, if you have a $10,000 limit credit card and you've borrowed $2,000, then you have a 20% utilization rate. Now the goal is to keep your utilization rate below actually 30%. Some people call this the 30% rule, where you do not want to have borrowed at the time that your credit card statement is issued more than 30% of your credit limit, because if you do, it will start to make your score go down. But if you stay within that 30%, it will not have a negative impact, but ideally the even lower your utilization rate is, the better it will reflect on your score. Now, in terms of student loans are not revolving debt, which means that they are not impacted, or they do not impact your utilization rate. So this is 30% of your score that your student loans actually don't impact because it's not revolving debt. Now, the age of your accounts are impacted by your student loans, because the older the average age of the accounts that you have open, the better. So if you've had student loans for a long period of time, then when you took out those loans, they have a birthday. And the older those loans become, the better it reflects on your credit score. Again, you don't take out student loans to benefit your credit score, but as long as you pay them on time, the longer you have them, the better it will look on your FICO score. Credit inquiries is when new people check your credit to open an account, to see if you qualify for something, and you want to make sure that you don't have people checking your credit for reasons that are not actually impactful to your finances. And when it comes to student loans, there will only be an impact if your credit loan servicer, or your loan servicer, checks your credit before they issue the loan. But if they do not do a credit inquiry, then it will not impact your 10% of credit inquiries as reflected on your FICO score. And then lastly, your new credit mix. Now, new credit mix is just an expression of the different types of credit you have. Credit servicers, they do not want you to have just one type. They don't want you to have all student loans or all credit cards or all auto loans, for example. But the better mix that you have of your credit, the better it reflects for this percentage of your score. Now, that doesn't mean that you go start getting different types of debt, because this is only 10% of your score, but that's what new credit mix means. So in terms of the impact of student loans, you can see the areas where it impacts your FICO score and the areas where it does not. Now, where it does have an extreme impact in a negative way is if you're not paying your student loans on time. So, for example, if you have been 90 days late on your student loan payments, then those loans are considered delinquent. But if you go into default status, which means you haven't paid your student loans in 270 days, then that can have an extremely damaging impact on your FICO score. The biggest thing that you see is that can be on your report for 7 years. The defaulted status can stay on your loan, similar to a bankruptcy, and stay on that credit report for up to that period of time. Even more important, you lose the federal loan privileges. I know that sounds oxymoronic, but there are certain privileges that you have when you have federal student loans, like the ability to put them into deferment or forbearance, or to have them forgiven under programs like income-driven payment plans or even public service loan forgiveness. But if you have student loans in default, you are not eligible to receive those privileges under default status. With student loan rehabilitation, you have an option where you can thankfully get yourself out of this situation and even remove the default from your credit report. So student loan rehabilitation is a process where if you make a certain amount of payments toward your loans over a 10-month period of time, then you can put yourself in a position where the default will be removed from your credit report, but the late payments will remain. So I believe that under the current plan, it's 9 months of payments over a 10-month period. There are certain stipulations that you can ask your loan servicer about if your loans are in default status. But rehabilitation, if available, is a great option to remove the default from your report. And while the late payments will remain, which will impact the 35% payment history on your FICO score, it's better than having the late payments and the default. Now, unfortunately, you're only allowed to go through student loan rehabilitation one time. So if you're not eligible for that plan, you can still restore the federal loan privileges that come with federal loans by refinancing those student loans and consolidating them into a consolidation loan with the federal government, or even putting them in a position where you refinance them with a private lender. Now, I will say that refinancing them with a private lender will require you to have a strong credit score. So it's highly likely that if you have student loans in default, they will not allow you, either because your credit score is too low, or they may have a policy where they simply do not allow you to refinance defaulted loans. So that means that what's more likely is that you consolidate them with the federal government, which would restore the federal loan privileges, but it does not remove the default or the late payments from your score. I hope this video was helpful in terms of income-driven plans and connecting the dots between what part of the plan impacts your credit in a positive and negative way. My name is Brenton Harrison with Ultra Borrowers Academy, and if you like what you've been seeing, we invite you to subscribe to our channel and subscribe to the notifications so that you're aware when new videos are dropped. And if you want to learn even more about student loans, both federal and private, we invite you to visit us at ultraborrowers.com, where you can learn more about Ultra Borrowers Academy. See you soon.